Hey guys, John here. Welcome back to the channel. Previously, I shared my analysis on the glove industry. If you have not watched it already, you can click the link at the description down below or at the I button that's going to pop up at the upper right hand corner of this video. So today, we'll be covering another industry which had its bull run in 2020, and that is plastic packaging. Before we start, just want to run you through the agenda of today's video. You'll be learning the global plastic packaging market's projected growth rate, our local companies' growth compared to the industry's benchmark, risks and growth prospects of plastic packaging, the 10 years financial comparison between our local companies, and last but not least, we'll be ranking them based on their performance. According to experts, the market size for plastic packaging is estimated to grow at an annual growth rate of 4% until 2028. You can see the graph illustrated by Polaris Market Research. The market size for plastic packaging is estimated to grow at $416 billion by 2026. With the slow industry growth, how has our local plastic packaging companies performed? Surprisingly, it is not that bad, especially Sintex, 𝗦𝐶𝗰𝗶𝗹, and Tongguan, where they achieve higher annual growth rate than the industry's benchmark. On the other hand, SLP Resources and Tommy Park were the underperformers among others. After we know a little insight on their future market size, let's have a look at some of the risks they are facing. Number 1. High competition. Back in 2012 to 2017, there was a high demand for plastic packaging as the product is portable and not easily perishable compared to other materials like metal and paper. It was an invention that changed human lifestyle, bringing both convenience and safety at a minimal cost. Consequently, many new companies were set up to fulfill the high demand since the barrier to entry is low to moderate. It is exactly what we are witnessing right now in the glove industry. With so many competitors fighting for market shares in the industry, it definitely creates a lot of competition, in turn putting further pressure on margins as a result of price competition, or what the market call it as lower average selling price. In addition to that, oil price can affect raw material costs like resins, and plastic products are produced from them. Not to mention, this raw material represents more than 50% of the cost of production, so it's quite a large chunk of cost that plastic packaging companies need to bear. Crude oil and resin have a connection to one another. Hence, you can see in the graph, both indexes' movement is relatively similar. As price of crude oil rise, resin price will also increase, leading to a higher cost of production to make plastic, hence lower gross profit margin. The opposite is true when oil prices fall. The extensive usage of plastic has created many problems to the environment as they are not degradable in nature. Governments in all around the world, including Malaysia, have been actively advocating the ban of single-use plastic products to minimize the impact of plastic pollution. In line with the global effort, here's a long list of countries that have taken action to curb non-degradable products. Hence, an alternative solution was born, essentially making plastic product that is biodegradable or easily decomposed. That said, it is a risk for plastic companies because it is an inevitable change, including those that are heavily producing single-use plastic, which means more costs are required to develop this new innovation, not to mention their existing machines may be useless if it's programmed to only produce single-use plastics. Ultimately, those that are able to adapt to changes and innovate will reap the most benefit and survive in this competitive market. But it's not all doom and gloom. Of course, there are its positive catalysts as well. Let me share with you what are they. According to Android Market Research, Malaysia online food delivery is projected to grow at a CAGR of 18.6% from 2018 to 2025 as a result of the pandemic changing the consumer's lifestyle. Basically, they need more convenience, which is having the food come to them. Plus, deliveries around Southeast Asia is estimated to grow at a rate of 39% until 2023, in accordance to Grab's analytics. All this means more food packages are needed. A scary fact, Malaysia tops the list on plastic consumption according to the Worldwide Fund, WWF. They reported that household consumption of plastic packaging amounts to 523,000 tons annually, which is as heavy as 5,029 adult blue whales stacked together. Imagine consuming that enormous amount of plastics every year. Before we deep dive into the company's financials, I just want to share with you their revenue contribution breakdown because some of them have diversified into non-plastic packaging related businesses. Hopefully, this can give you some further insights on their business behavior. For instance, some of them may incur more debts or spend more on capex due to their non-core business segment. Here are our local plastic packaging companies' market cap, enterprise value, revenue, and profit for 2020. As you can see, 𝗖𝗵𝗃 is the largest, followed by 𝗏𝗏𝗏, 𝗓𝐶GM, and the rest. Interestingly, 𝗏𝗏𝗏's revenue for financial year end 2020 was almost similar to their market cap. Looking at their revenue growth comparison, it seems that 𝗓𝐶GM grew the most among its peers, followed by 𝗖𝗵𝗃 and 𝗏𝗏𝗏. In contrast, SLP Resources and 𝗏𝗵𝗶 were dropping in revenue growth. Out of the 5 companies, only 𝗖𝗵𝗃 and 𝗏𝗏𝗏 have economies of scale, which is justified from their gross profit growth being higher than revenue. Likewise, with net profit growth, 𝗖𝗵𝗃 and 𝗏𝗏𝗏 both rank first and second among their peers. I'm not sure why 𝗏𝗵𝗶's net profit dropped 100% though. Maybe you guys can enlighten me on this at the comment section down below. Here are their profit margins. Nothing too interesting to comment on, other than 𝗓𝐶GM and SLP Resources being a better margin performer than 𝗏𝗏𝗏. Another clear winner for 𝗖𝗵𝗃, with an outstanding operating cash flow growth of 30%, suggesting that the management is really doing a good job in improving their day-to-day operation. On the other hand, 𝗏𝗏𝗏 and 𝗓𝐶GM are also equally commendable. I added the CAPEX growth because I'll be showing you their free cash flow growth in the next slide. Basically, this shows that 𝗖𝗵𝗃, 𝗏𝗏𝗏, and 𝗏𝗵𝗶 have been actively spending to grow their businesses, while 𝗓𝐶GM and SLP Resources reduced their spending for the past 5 years. Which is also why 𝗓𝐶GM had the second best free cash flow growth because of the less spending on CAPEX. On the other hand, 𝗏𝗵𝗶's free cash flow grew the highest, in line with the operating cash flow being higher even with the increase in CAPEX growth over the years. Interestingly, SLP Resources has the highest dividend growth among others, rising as high as 23%. Though I'll be cautious with this number as their free cash flow and revenue are showing signs of a declining trend, which was presented in the previous slide. Alternatively, 𝗖𝗵𝗃 and 𝗏𝗏𝗏 seems like the safer option with their consistent growth in overall sales, profit, and cash flow. In terms of inventory turnover, 𝗏𝗵𝗶 and 𝗓𝐶GM has the best turnover rate, indicating their inventories are the quickest to convert into cost of goods sold, while 𝗏𝗏𝗏, 𝗖𝗵𝗃, and SLP Resources are falling behind in the industry's benchmark. On the flip side, it appears that both 𝗓𝐶GM and 𝗏𝗵𝗶 perform poorly in terms of converting their products into cash, taking more than 4 months for the conversion process. Though it is not too far-fetched from the best performer, 𝗖𝗵𝗃, which is 1 month ahead of them. Based on their return on invested capital, 𝗏𝗏𝗏 was crowned number 1 in making the best return compared to its peers. Surprisingly, SLP Resources was a better performer than 𝗖𝗵𝗃. Meanwhile, 𝗓𝐶GM and 𝗏𝗵𝗶 are the only 2 performing below the industry's benchmark. After analyzing all their financial data, here's how I would rank them. In the 5th place, we have 𝗏𝗵𝗶 due to their poor growth in profit, cash flow, and efficiency. The 4th place is SLP Resources. 3rd place was a little tough to decide, but after comparing their efficiency ratios, I have to place 𝗓𝐶GM in the 3rd place. Coming in number 2, we have 𝗏𝗏𝗏, which I find them almost as perfect as the number 1 spot, 𝗖𝗵𝗃, with their consistency in growing their financials over the years. So here you have it, the top 5 plastic packaging companies in Malaysia. Thanks for staying till the end. Make sure you smash the like and subscribe button for more analysis like this. Before we end this video, I just want to highlight the importance of understanding the business qualitatives, as numbers without fully understanding the business are practically useless. That's because present and past performance does not represent the future. Even the best accountant, auditor, or mathematician may not be the best investor, because investing requires you to know more about the business, and it is very subjective to everyone. At the end of the day, it is those who fully understand the company and their value chain in the market is what separates them from the norm. Once again, thanks for watching and till next time.